Now, Michael, I wanted to ask you, maybe you saw my comment here on the space, but I wanted to ask you more about like a tactical approach or like it's a question. You've mentioned more manipulation coming into the market, that kind of stuff. Like, are there arrays or frames or things that we can look at? You have all these like entry arrays and like arrays for a draw. Like, are there arrays or frameworks to spot manipulation? I mean, I know seek and destroy is like something we look at. You posted that drill that you do this last week to see if things are as you expect. I don't know if like looking at the coupled markets, the correlated markets not being coupled. I don't know if like the nearby contract spread is like another way of looking at it. I don't know if you would like to share any of that stuff. I mean, that's kind of my question. Thank you, Michael.
As far as manipulation, I mean, you're never going to fully know it all. Like you aren't going to be able to know everything. And when it's fortunate enough for us to see it in price action, when it's sharing a lot of the previous candle space where it overlaps a lot, I call it fuzzy, when price looks, it's not spread out and given fair value gaps and imbalances and stuff, which is what I want. I want to see that's clean price running. If price is not doing that, it's spending a lot of time sharing previous candles, ranges, or the majority of it. I'm very reluctant to want to trade in that environment. I will wait. If that means I got to wait until the following day or following week, that's what I'll do. But as far as like PD arrays or things, the tools that help with discerning manipulation or whatnot, nothing outside of what I've already taught. It's a thing that I concern myself with a lot. When I was younger, I stressed about it and thought about like I have to have more. When I realized that price is going to just indicate that, hey, look, it's not clean right now. If it's not clean, it's not in a hurry to get anywhere. If it's not in a hurry to get anywhere, then why am I rushing to get in there and risk money? It doesn't make any sense because the market's going to indicate by its ranges. It's going to be small ranges that expand to big ranges, and it's going to leave porous wake behind its runs, meaning there's going to be imbalances left, breakaway gaps, fair value gaps that it trades up into and doesn't fully close in. That's what I'm looking for. When the market's not showing those types of things, that's the biggest indicator, billboard sign saying, hey, look, you're probably not in the best market environment. It doesn't mean that you can't trade, doesn't mean you can't find winning trades, doesn't mean you can't make money. Okay, because I know some of these individuals that listen to me say, I'll trade it to this, look what it's doing, ICT never would have done this. It's all this dick measuring. Like, I can do something when ICT said you couldn't do it, and all you ICT traders, this, that, and that thing. They're all trying to find themselves as a counterparty to what we do. And that's unfortunate because we're not out there trying to say, look, we're counterparty to you. We're out here just doing what we do, and it's just winning. And we know when not to engage. That's a huge advantage in and of itself. So by knowing what the price delivery looks like, what's the hallmark of low resistance liquidity run conditions? It's open ranges, large ranges that are elongated, and it leaves porous wake. That means when it starts running lower, look back through that price run. Is it leaving pockets open? Is it leaving imbalances open? Is it going into the imbalances and leaving some of it open and continuing on? That's a healthy price run. That's exactly what we're looking for. So by keying up on the characteristics of when a market is not showing those things and not just simply trying to figure out, okay, ICT said the easiest thing to do and the most important thing is to know where the market's going to go. Yeah, that's great. But in concert with that, the next step is, are we in a market that is conducive for a low resistance liquidity run, relative equal high or low? And that's why I'm saying it's what we do is not complicated. Right away, if you understand what I just said, that removes so much of the ambiguity and the hardships of what people struggle with by using my concepts. Is it the right time to trade? Okay, when is that? Well, you don't want to be trading between 5 o'clock in the morning and 6 o'clock in the morning, Eastern time. You can start as early as 6:30, but then when you get in 7 o'clock, then you're in that pre-market session. Things are going to happen. But is the market, just because it has relative equal highs or lows there, is the market running with porous price action gaps behind it? Is it leaving inefficiencies behind it? Is it coming back up into the inefficiencies? Is it completely overlapping those inefficiencies and staying right back in the previous range it just left from? Because if it's doing that, what is it indicating? It's high resistance. So if it's high resistance, sure, it can go to those relative equal highs or lows that you think it's going to go to. But are you willing to absorb the risk in this current climate? Or would you say, no, I'm just going to wait until the opening bell at 9:30 and see what the first 30 minutes does? And then see if it indicates a willingness to want to get somewhere quick and leave very clean price action. Because if it's doing that, it's indicating it wants to move, and it won't be done just simply because it goes to that relative equal high or low. It's probably going to do a deep retracement or continuation. Either or, it gives you another chance at finding the next price run. But that's to me, that's the easiest general rule of thumb to determine if you're in a market where manipulation isn't in the cards. It isn't in the minutia right now. Just focusing on that makes it a lot easier. And I'm not sure if that helped you, but if I was asked that question in any other way, that was the response I would always give.
Yes, absolutely. That's very clear. And it's not about looking at like other stuff that's outside of the market we're looking at, right? It's like more about the price action that we're getting delivered.
Right. Because, I mean, one could say, okay, look, where does SMT fall in this? Where is correlation or the lack of correlation, SMT, that type of thing? Where would it fall in that? I wouldn't even look at that unless the market's already indicating that there's an obvious draw on liquidity. God bless you, babe. God bless you, babe. The idea of it wanting to reach for a relative high or low, and the market's showing clean price runs. Then, if it runs a short-term high or low and it's not seen with a correlated, like for instance, ES and Q, if it fails and there's a SMT divergence there, then that absolutely gives rocket fuel to the idea. I'm not looking for SMT to justify an idea of manipulation. I'm looking for, is the market poised to trade cleanly to a level that's obvious and they're going to target it? So I have two things in my advantage already. And then it shows the actual manipulation that would be contrary. In other words, running up and make a higher high in NQ, but ES says I'm not going there when the relative equal lows are below us on both indices and the market's running cleanly. That right there is like, it's a green light go. As soon as it gives you a breaker, model 2022 sell, or a first visit fair value gap, you name it, whatever mechanism you're going to use to get in there, get short and look for those relative equal lows to get tagged, and not expect that SMT to be violated once the high's in place. The first fair value gap that forms after that is going to be model 2022 entry, or it stays as a breakaway gap. Either or. If it can't go up in the enter or short into it, it stays a breakaway gap. Then use a breaker, bearish breaker, use an entry on that, and then just trade anything after that. Institutional order for entry drill, or a regular fair value gap, short, or immediate rebalance. Anything that gives you a entry mechanism to get short from, treat it as a premium array until it trades down to half of the range before it gets those relative equal lows. As long as you're entering in the upper half of that, above equilibrium, you can enter. But once you get to equilibrium, don't chase it, don't do anything, because you run the risk of seeing, even in clean price runs, very loose liquidity runs, it can still have deeper retracements, and you're actually entering in a time when retracements could happen. But once you get down to the lower third of it, or lower quarter of it, you don't usually see a stop run. So it's usually a real quick run to the relative equal lows. So I just gave you a whole clinic right there in a couple sentences on what you should be looking for optimal entries, optimal conditions, how to use a very short list of things, no moving parts, no long list of moving parts. And it's just where you look for things to form. And not every one of the PD rates are going to form in that price run, but whatever forms, if you understand its premise, you can position yourself. Like I just did the other day using the Zircon model. Like I was taking every potential PD array there while in the upper half of that, and just building it with a micro, and doing better than most people do when they're trading their multiple contracts, on a full mini. And I'm doing it with a micro. So you can make plenty of money, but you have to be patient and you have to be selective. Not only patient, but you have to be very, very selective. Just because you see a relative equal high or low, just because you know it's the right time to trade, is the market by price action? Is it showing very clean price runs, leaving inefficiencies? Is it quickly trying to go back over top of them and staying inside of it, filling in that fair value gap with multiple candles and not trying to go anywhere? Is that indicative of a clean price run? Is it low resistance liquidity run conditions if it's doing that? Absolutely not. So by spending more time looking at when the days trade very cleanly and when days are very fuzzy, when candles share a lot of the previous candles' highs and lows or the majority of their ranges, that is indicative of a time frame and session where I'm not participating in. I will watch it. I'll tape read it. I may go in with a demo account just to see if I can get a better read on what price wants to do. But as far as throwing in real money when it's doing that, I'm not going to do it.
Wow. Okay. So, Kit, I'm sure you're ecstatic about this. I'm gonna be nonchalant about it, but that was like one of those heavy, heavy gems
Oh
that you
yeah.
went
Oh
with.
yeah. 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 Yeah.
Oh my God.
What I heard, and I mean, everyone hears different things and everyone's going to understand different things. And I think that's the beauty of the conversation. And Michael just said a lot of things that were very, I think, in depth. But some of the things that I heard, Michael, and maybe you could pontificate further on this, was I heard, and you're going to be like, how did you hear that? But I heard like speed from arrays and how quickly price is moving to or from, maybe point A to point B. Like, I don't know, while you were talking, just intuitively, I thought of like the term velocity. And
Mm-hmm.
yeah, that's just what I don't know if you want to touch on that at all, or if that like adds anything, just like riffing or thinking about what you were saying and as in depth it was, I was like, wow, like I'm hearing speed, I'm hearing velocity, I'm hearing like the way price is reacting from these different arrays is really gonna help within the trade plan towards what we're looking for or anticipating, as you're saying, these clean price runs and where and how efficiencies are left or not left, and whether that's a high resistance price run or whether it's indicative towards those clean as a low is swept or taken, and as you've explained before, and enveloped to then quickly turn around and violently go the other direction towards what would then be a different point of liquidity, right?
Well, if you recall all the examples I used to do, and I would do the annotations as of recent, the volatility in these markets today doesn't afford me the luxury of reading the candlestick, anticipating what you guys are going to be looking at and thinking, why is he going to pick that? Why is he going to pick that? Why is he doing that? I'm trying to make it as simple as I possibly can using what's available in price action. And I don't have always the luxury using the time frames. I'm using like 1 minute, 15-second chart, something like that. So many things are happening. I used to be able to, like when I was doing Forex. Forex is a little bit slower. So I could go over and type out, this is what I expect to see. I want to see speed and magnitude here. I want to see it drive aggressively. And now I want to see these long stretched out black limousines going down the 654 Club. Okay, 654 Club's the draw. Okay, everybody wants to go there. That's the hot place that's happening. Well, whatever that is, if we're bearish or bullish, you're correct in what you were listening for is you want to see if, for instance, say it's a draw higher, just to change the tone of the conversation in another direction. Say you think it's going to go higher. Your bias is higher. You think it's going to draw to some measure of buy side liquidity. You don't need it to be bullish for the whole day, but the session you're in right now, you think that is a suspect level, and it makes perfect sense because they've already explored going lower. We had a shift in market structure to the upside. There's a small little short-term high that's been pierced. Maybe there's a SIBI that formed on that most recent low, and you anticipate that becoming a inversion fair value gap to be long on. Price trades down into it. It's respecting the upper half. It maybe throws a wick down inside the lower half, which I love that. I want to see that right there. That's a beautiful signature right there, Daji. Keep that in your notes. The bottom line is if it leaves the lower half open, it can come back in there and lay a wick down in it. So you want to see that wick dropped in there initially, right from Jump Street, once it first goes in there. Once it does that, it's proved to you by leaving the bodies in the upper half and then starts running. Now, what do you want to see after that? Every down close candle repel price higher, not see half of its body be breached with a next candle close. In other words, it's respecting the upper half of it. That's institutional order flow. That's real algorithmic order flow. It's showing you that you don't need to know the numbers of the fucking volume inside the candlestick. Fuck all that bullshit. The open, high, low, and close is going to show you everything you need to see. So if you're bullish and you're expecting that buy side to be hit, do you want to see lethargic runs off of these upper halves of the order block or the PD arrays? Absolutely not. You want to see the minimal amount of time in these ranges on the PD array, but you want to see like a little spur of energy, like it just rips away from it. It doesn't mean it's going to go straight up and start moving 500 handles from it, but when you are watching price action, the retracements that move lower will be slow. They'll be orderly. It'll be like tick, tick, up a little bit, tick, tick, down a little bit, up a little bit, tick, tick, down. So it's lower, lower, easy, slow, controlled, and it's paced. But when it hits the PD arrays and the half of the PD array, either the premium side or the discount side, to our discussion here on this example would be, we want to see the upper half being respected and not use the lower half. Because if it starts to repel price on what we would expect the discount sensitivity on the upper half of the inversion fair value gap, once it threw a wick down in it, and it keeps all the bodies out from underneath the midpoint of that, all the energy should be visibly represented by you watching the candles form. I don't need this stupid shit that people have looking at order flow, candlestick, what's inside, how many orders are buying here, the profile this and the value high and the value low, the component control. Fuck all that. I'm watching the candlestick breathe and form. I want to see what it's doing. And is that momentum being illustrated in the candlestick's formation all while it's still moving around? I don't need it to close. I'm watching as it's forming. You will see the breath breathe right into these candlesticks that will propel. That's what I'm doing when I was calling candlesticks out live and say, okay, now you want to watch this right here. And it's not going to go down below here. It's going to stop right here. Watch this candlestick right here. Watch the upper half of this right here. I'm telling you what is inside my brain as an internal dialogue because that's what I'm looking for. And as long as price is showing those things, that means all the little energetic flurries while order flow is bullish, it should be seen visually. Watching the candlesticks, it should be visual. It's not simply me saying, well, obviously, if the candle's going to close up, it's going to be an up candle, and it's going to be a lot of momentum. It's not the same thing. Look at how these candlesticks are forming right now. There's a lot of volatility, and it can go up and down a lot in these candlesticks before they finally close. But are you seeing the energy of them sprinting away? And you see this down in like a 5 or 15 second chart. You don't see it, but I'm looking at either I have my phone on if I'm recording off my laptop, usually I have my phone. I haven't been up in my computer room for months now, but the idea is I have a 5 or 15 second chart watching the same time frame that I'm recording. If I'm doing an example to share with all you, I'm looking at the lower time frame second chart and I'm watching to see if that lower time frame chart is creating little fair value gaps that stay open. Because they're like micro gaps. They're acting like breakaway gaps. And it's after trading into the discount sensitivity portion of the PD arrays. So the upper half of every PD array that I expect is something to be bullish, I'm then measuring what is that lower time frame 5 and 15 second doing? Is it leaving tiny little micro gaps on those time frames? And if it does, that's telling me order flow is absolutely bullish. I have nothing to worry about, and it's not going to trade down in the lower half of these levels. That's why I'm right. That's what makes me confident to point out these things beforehand. That's why I do it, because I'm looking for things that I know work. They're not gimmicky. It's absolutely visual. You have to be a visual interpreter of what price is doing by watching it. And you pick these skills up over time with experience by tape reading, without putting any trades on, just watching the candlesticks form, expecting them to behave a certain way. And then as each new down close candle forms, I'm watching the same thing happen. But if it creates a swing low, if it creates a swing low below the equilibrium of the run, where it draws up to the relative equal highs, and that's the buy side we're drawing for, the low it formed from, that's your range. So where's terminus? The equal highs. So the range started at the low, measure that, find equilibrium. So we're anticipating 2 runs dropping down. What's that going to be? Market maker buy model. So the first swing low, we don't want to see that run that out. But if it creates a second one, that one can do it if there's manipulation. So if I do get an entry on, say I'm trying to do second stage reaccumulation, I'm trying to buy off of a discount array that's in the lower half equilibrium of a market maker buy model. I'm seeing all the signatures on the lower time frame telling me everything's good. I enter. It starts moving in my favor a little bit. Then it stops me out. If it stops me out and goes right back above that short-term low and it finds another discount array that's higher than where I just got stopped out at, I go right back to watching that 5 and 15 second chart and I'll re-enter again, knowing that the stop hunt's already been done, the manipulation's behind me, and I will put my stop loss right below the stop hunt that just happened. And I could just I always walk away from it then. I ain't worried about it because I know it's going to go to my relative equal high. And then as it moves again, I'll start building in the original position, but I enter with half of what I just took the loss on. But eventually I'll build that same position back up and sometimes even greater as long as it affords me the opportunity to do so. But once we get above that equilibrium price point of the run that it originates from, that means the low, then it creates that inversion fair value gap or model 2022, whatever it forms. It's either model 2022 or inversion fair value gap. That's it. You're getting low risk entry on one of the two. That's the only thing you have to worry about.
It goes lower low, intermediate term low, or short term low, sometimes if it's the manipulations, but we really want to see the swing low first. So a lower low, and then we're kind of counting swings, right? So you have a swing 2 and a swing 3, and you're saying there could be a manipulation in swing 2, but we want to see a higher low if we're going higher. So we want to see a lower low, higher low, and we're looking at the speed in which that higher low is happening off of that lower low. So within kind of counting not just candles, but then swings, we're really looking to see if one of these swings fractally is going to kind of be protected within this fractal distribution that we're trading. Is that correct? I mean, because we're really looking at, and speed is it's something that you've done on the 1 minute chart, Michael. And it's something that, I've watched that, and I think all of us have in awe in the mentorships in the past in 2023 and 2022, 2024, when you have gone on the 1 minute chart and you've done exactly what you're articulating right now, in which you're explaining how a candle breathes. And what you're mentioning right now, that breath of a candle in its formation in the OHLC, and being able to see that in a sub 1 minute chart, I think a lot of your students have really revealed their own clarity in seeing and understanding OHLC, myself included, in being able to find that accuracy through the quickness and the speed and the momentum that sometimes these inefficiencies are left. But they're a tell. There's a directional tell to some of these uber small time frames I'm referencing when I say an inefficiency in this regard. But otherwise, it translates into just the price and price movement of, as you're saying, how the candle breathes. So that point, I think anybody and everybody who has the opportunity of going back and listening to this, and I would say, again, as someone who has followed very much it's almost a meditative process when you get in that zone, Michael, of really, I want to see this candle do this, and then I want to see it do this. And you have very clearly, again, it's recorded. We can all go back to the tape and listen, go back and watch and listen to that flow state. And I think you have encouraged, I think you've demonstrated, I think you show, your students, the community, how to kind of enter into that candle breathing, candle reading flow state from a sub 1 minute chart. So I believe personally, I am not the only one stating that you do this. I am identifying within the community that we know you do this, and we as your students try to emulate that. I do believe this, that there are a lot of folks that are trying to really get into that flow state. And it is through your vocabulary. It is through the logic. It is through the philosophy. It is through algorithmic price delivery. It is through the market maker models. It is through, the high probability trade setups that you talk about. It's in the, swing trade setups you talk about. Again, core content month 6, or, short-term trading 7, or high probability trades 8. You talk about it throughout your delivery of material. So again, I just think that's awesome. And that emphasis for anyone who's listening, how a candle breathes, and then that speed that Michael is explaining and how he has explained it, I would suggest or implore that you go back, find the price action videos in which Michael is utilizing the chart as this classroom of price, as he's referred to it in the past. And you are learning. This is the most invaluable skill that you can learn as anybody within the community. All of this is learning how to understand the candle breathing. I love that, how you said that, Michael, because I believe it's almost meditative within someone's own academic
Once you
understanding.
reach this level of knowing what you're looking for, notice I didn't say knowing what's going to happen. There's a difference. Okay. I don't know the first entry I take. I don't know if that run is going to fully materialize. So when I put in my first 6 contracts, okay, I'm going to fully commit to my average position. 6 contracts go in. It gives me something to feel the weight of. It lets me know, okay, I'm committed to this. I care about the outcome of the trade. It's not just something little. Okay, I want to feel it. If I'm offside, I want to feel it. And 6 contracts go in, and then I go in and I want to watch and see. I want to go back and say what I said again, because I don't think I communicated correctly enough. When we're looking for a market maker buy model, we're looking for the smart money reversal. The smart money reversal is, I'm usually able to see that form before it happens. I know what I'm looking for, when it should reach down here and then start turning around. In recent months, I have been surprised by how many times they'll come back for that low. And that's what makes me thankful that I'm not risking a lot of money until we get into February, because I want to get through the first month. But that low I'm hunting, I'm treating that as a smart money reversal. I may get the low. I may short the high. Okay. But I'm not insisting that I do that. If it allows me to do that, I will. But that drop down into it, that low that it's forming, I already have in my mind one of 2 outcomes are going to happen. Either it's creating a model 2022 long entry, or it's giving me the inversion fair value gap. So the drop down, if it creates a SIBI there, that's nice, it's obvious, and it leaves a little bit of range off of the low of the SIBI, as it drops down and creates that low that creates a smart money reversal. And I know some of you guys that aren't familiar with this, it's over your head, but the people that know exactly what I'm referring to, that single low that creates the lowest point of the price run. And it's going to target the original consolidation, the relative equal highs that we're looking for to draw up to. I'm anticipating one of 2 outcomes. I'm not worrying about anything else. If the price overlaps and doesn't create a SIBI as it drops down, I already know it's going to be model 2022 as my entry mechanism. So I'm going to wait for the buy side and balance sell side efficiency out of that level I'm anticipating that low to form on. And then when it drops down into the upper half of it, I'm going long with my first 6 contracts there. Then I want to see immediate feedback. Is it defending the lower half of that gap that I just bought? It can wick down there. It doesn't matter to me, because my stop is going to be below the low of candle number 1 that creates that buy side and balance sell side efficiency, which is model 2022's entry. So I already defined my risk. I already know what I'm looking for. And as long as it's defending that lower half with no bodies in the lower half, I know I'm on side. Then the market rallies up a little bit, and then every discount array that would be used as a PD array, I want to see it use the upper half of it, show willingness to spur and run away on the 5 and 15 second chart, leaving little micro gaps that it does not come back and fill. You won't notice this all the time on the 1 minute chart because it doesn't show up. But on these lower time frames, it's giving you the little fingerprint that's saying, I got you, Dad. You're on the right side. Just hold what you got. And then I just build it every time it goes back into these little retracements on the 1 minute chart. I'm justifying it by seeing the gaps that remain open on the 5 and 15 second chart. And you don't see that because I've guarded it for so long, because a lot of my students are catching up. I mean, they're getting really good at doing a lot of these lower time frame, trading mechanisms. But you have no idea the joy of knowing what you're looking for and the freedom and liberation that you get from having to no longer worry about, what am I waiting for? What am I, waiting for something to just materialize that's obvious, but we don't even know what that is. Versus, I know this low should be tradable. It should start running off of that low. It went down to a new week opening gap high. It's the first return back to it. It's dropping down at 9:30. It's the first 30 minutes. It's dropping down there. It's going to go right back to that. And then it's so many obvious things that's going to take the price up higher. Plus the daily chart's calling for the move higher too. So there's so many things slated for this to go higher. So I'm only looking for justification to get in on a inversion fair value gap, or if there is no city as it drops down, what is it going to be? Model 2022. There's nothing else to concern yourself with. And if you can throw a wick down into that inefficiency and not leave a body in it, there's your easiest telling you got it. As long as you enter, don't go crazy with the leverage, but very few times using that do I get stopped out. And I just start building the position. And then the feeling you get, the confidence that you get by watching these candlesticks form, and it's like, I tap into everybody else's excitement because I'm bored to it now. So I love when I show the videos and I read the comments and they're like, that is amazing. Like you're marking it out. You're doing this, and it's not ego. I'm not, please don't take this as ego. I am tapping into things that I don't feel anymore. So it's like a photo album for me. I get to relive all these moments vicariously through all of your sense of astonishment, because most of you don't believe these things are possible because you believe what the internet tells you, that no one can time the market, or I'm just a demo baller and it's always hindsight stuff. You can't change most people's opinions if they don't want to learn. If they're set in their mind that they don't believe it's possible, then they're closed-minded. They're never going to see it. But I encourage all of you to do the things that I teach, because as soon as you start applying them, the application of it, and the time and experience that's cultivated from doing that, you will see what I can't teach. And it can't be translated. Even if I sat over top of the charts live and explained it over and over and over and did it every single day. The only thing that would do is tether you to me, and you would feel a sense of dependency because you wouldn't trust your own, I guess, skill set.
But your methodology and what you've taught, I believe, is very obviously it's apparent that, I mean, you are teaching millionaires. You're teaching people how to read the market. And I will just say from all of this, Michael, and just to bring it full circle, within what you've done this year, what you've done in the past, or maybe what you do this year in the future, that flow state of you on the sub 1 minute chart, literally just reading it as you've talked about so many times. All of us can say countless times, oh, he did it in April of this month, or he did it in February of this year, and can go back of different times where you literally went and read the 1 minute chart. But I think a lot of the newer followers, a lot of the naysayers, a lot of the easy ways for you to just be you is, I'm just saying, like it's like your students as well. Really, and I want to include myself, like I really love trying to get into that flow state onto the sub 1 minute chart. And if you're live trading, or you're within that state and you're able to see the market, which you can clearly do with your concepts, with what you've taught, with the vocabulary, with the logic, with all of it, right? That's the whole point, with all of it. And it is replicable because you've taught this and more people than just you are doing it. And that's what we're manifesting, and that's what's coalescing in a much stronger form within technology, and with where and how we can utilize community in a positive way. This is it. And people are able to see that it is real, that it is possible. And that's the listener, not just for you, as you're saying, Michael. It's like, this is just like, it's old news for you, right? It's not as a big deal for you, but you being able to do this, and then for folks to be able to see that, again, it's magical. And as just someone that gets to kind of narrate or talk about it, or also witness, and as someone who has spent quite a lot of time trying to replicate that skill set. That's the skill set, Michael, that I believe is transferable, that you have communicated on your channel so effectively. And that's how to understand the breadth of a candle. And then your life's work really explains that in so many different angles and perspectives and ways in which to go about it. So I just wanted to add that, my thoughts.
That's awesome. Thank you for sharing that. I always wonder, like, do people, number one, do they believe they can do this? Because I have students that the base is growing and they're doing amazing things and you're bringing the receipts and you see it. But there's a lot of other people that just want to remain private. Like, they're not like you. Like, to me, you're like an extrovert. To me, I'm an introvert. Like, I, I wish I had the outgoingness. Like, you hear me talk in a space and I can get revved up and do the whole thing. But if we were together in the same room, I wouldn't be like that. I would be quiet. I'd be Mr. Rogers all the whole time. But I find my comfort in knowing that I can present myself in a way where I want to be strong about what I'm sharing, but I don't feel that's necessary if we're in person. And I often wonder, what does it feel like when my students are able to do this and they did it all by themselves and they see where the market's going to go. They enter into their trade, whether it's demo, who cares? I don't care about that. But that moment when they get in there, they execute, they have next to no drawdown. It goes up and starts moving towards them, and they might throw another contract on just to feel what it feels like to add to a position. And then it just starts walking towards where they think it's going to go. And the confidence and then the doubt of, oh, is it going to continue? This feels too good to be true. Is it really going to keep doing this? This is crazy. Like, and you start looking around the room like, is anybody else watching this? It feels amazing when it goes to that target at that terminus. Just the first time that you had that experience, I don't think I've ever heard you describe what that, but for someone that spends a lot of time in the charts like you do and trade and participate in price runs, can you like articulate the first time what it felt like for you when you mapped out what you thought was going to happen? You engaged with it. And I don't care if it's a demo. I don't
No,
care.
and honestly, to your point, Michael, I honestly believe, and I think there's more flex within the community. The longer you can engage in demo, then the stronger you become as a trader. I think
Oh,
you've made
absolutely.
that very, very clear. I think throughout the embodiment of work, the less that you attach yourself from the results, or the less that the easier you can detach yourself from the charts, which will only come through mass repetition in demo, to where you can walk away from that decision and it doesn't impact you. It doesn't affect the dopamine. It doesn't affect what you would be feeling emotionally. That ability to detach, and it's something you've preached, teached, and been advocating about within the community, and I believe is the flex. If you are a young trader, it is the flex that you do not utilize real money, because the longer that you can go in this demo that Michael is explaining and is asking and imploring me to give greater detail on, when you are, and I will ask that you watch, any of you listening, my live streams. Okay. I tried to emulate what Michael has implored all of us to do. He has implored for years for all of us to step out. And as Michael is saying, I am a little bit more extroverted, right? So I happen to not be afraid of trying to follow the assignment, right? But in the vein of literally going into, I personally, the 15-second chart, I really like it, but I have more peace on the 30. Personally, right? So I like the 30-second chart. I've spent a lot of time on all of the sub 1 minute time frames, from the 1 to the 5 to the 15. And I know and I understand the reason why the 15 is the 15, but I still personally, there's something about the 30 that really resonates with me, right? So I like the 30. And when we're talking about price runs, and to your point, Michael, like a really good substantial trade, when you're able to be on a sub 1 minute chart, and the market is, as you've defined, or as we define as a community, in high definition, in which you're able to see every niche detail, every inefficiency, every wick, the body, the formation of the ratio in which the wick forms to the body. And then the next candle, and the next candle's body ratio within its formation of the wicks. And then it's not only just the ratio of the body formation, and then also the wick in relationship to the previous candle as the range is forming fractally, either from that 15-second or a 30-second or 1 minute. And 1 minute's very comfortable because it's a 1-to-1. And you taught that also very, very clearly in understanding price, time, square. the one-to-one relationship of time and price, which most folks don't really totally understand, but you learn that over time. Time and price, one-to-one's relationship with each other, and reading again, like you're asking Michael the skill set that you've conveyed to us, the listener, and I, as being the more boisterous, extroverted, student of yours, get to, externalize and explain, voice for, boisterously what I believe is important. And that is that what you are saying, the breadth of a candle, the ratio, the size of the wick, the size of the body, the inefficiency that forms within the body, the displacement, the size of the wick. And as these are daisy chaining and forming on each other and creating what then becomes structure. And as you've talked about so clearly, microstructure that then creates a macro structure. And you go back to the 2022 mentorship in episode 12, and we talk about intermediate term lows, short term lows, long-term lows, and where and how those form, and the price signature that falls in line with the market maker models, and where and how you can utilize the Fibonacci to get onside with where and how you want to read price. And to your point, Michael, the intimacy and understanding the clarity, the breadth of a candle, and that price run of, hopefully, the more you desensitize from being able to add contracts to, being able to be 100% neutral to the outcome, but still be able to watch literally generational wealth print on the chart based on a good decision. Michael, you've talked about low drawdown trades. I try and utilize my live stream to show people where and how I'm in quick and we go, or I'm out quick. So, I mean, I'll take I'll get chopped up a lot, and I don't mind getting chopped up, because when it's going to go, it's going to go. And I'm looking for that speed, and we need that speed. And you've really talked a lot, I believe, through the breadth of how you talk about a candle, that speed on the arrays that we want to see happen. And if you don't get that speed, then there's a good chance it's not the right time. You're not on the right candle. You're not in the right. It's not it.
Mm-hmm.
Anyway, that's what I wanted to say, Michael. I mean, hopefully I answered your question again.
I believe that majority of what many of my students leave comments, or they'll say something on X after I share something, or they've done a trade and they say, I felt a lot of fear with this, and I had second thoughts or concerns about it, going to where I thought it was going to go. It was very hard for me to hold to that trade. I'm convinced that if individuals spent more time with these lower time frame charts, not that they have to stay with that as a model, or that's what they're going to always use as a trader, but it gives them lots of canvas work where they can spend looking at price action, the ebb and flow, reaching for liquidity, inefficiency, back and forth all day long. You could literally dozens of trade setups on a 5 and 15-second chart, using a 1-minute chart for your draw on liquidity. And you can micro scalp that thing to death all day long, up, down, all over the place. That's not an invitation for you to go out there and run up a huge bill with your broker with commission costs, okay? Or just go,
No, it's be a student and take a semester and actually be a student in demo and do exactly what you're saying, right? I mean, really, it's like take a semester and study. I believe a lot of your content, Michael, is really taking, if we're talking about a master's degree, if we're talking about 18 months, taking, 6 months to a year in that high frequency price delivery. I believe you have more than enough content that affords the student the ability to do that. And then hopefully I believe very similarly, you start from that high frequency, very low time frame ability to see fractal delivery, that then you can zoom out into these higher time frame arrays. And then you could really follow the, core content month 12 high time frame, economic calendar down through, your weekly to daily. And as you're teaching now with the wicks and the importance of grading wicks within a daily intraday range.
That's a lot. You say a lot in a little bit of time. You cover a lot of stuff. You got your bandwidth is broad. It's very fascinating to hear you talk about my stuff. It's like you can say a lot of things in a very short span of time. I'm not sure if the audience picks up. I mean, and you're talking my language. I get it, but I often wonder myself, like, are you are you able to be received by the audience, because what you're saying is a lot, and that's what makes me the trepidation I have when I talk, and I talk slow. And if you ever listen to me at 2 times the speed, I have this cadence, the rhythm and how I speak. It's very noticeable when you listen to me at 2 times the speed, and I've never heard that in my speaking because I just never listened to it. But I'm very careful about how I say certain things because I'm trying to answer as close as I can to textbook response, because the books that I'm writing, I want everything to match what I've said in the past. I don't want to have someone say, well, you said this and that other thing, and it's going to cause confusion and it's going to cause doubt. And I don't want a million emails sent to me when people get the book and read it or whatever and say, well, this is what you said here and there. So I'm very careful about what I say. Now, when I'm speaking passionately, and I usually blue collar language, there's no pausing, there's no cadence there, except for just like what you just say. When you say what you say, it's like full speed ahead, bulldozer. You're comfortable with what you're saying because you know it, you lived it, you've been dealing with it. But as the person trying to make sure that I'm teaching it in a way where I'm not going to cause confusion, I'm very selective on how I say certain things, because I want them to match up to what I say at later time. When you have it in text, that's it. That this is what I meant to say. I may have said it incomplete, not by intention, or I may be omitted. Like, for instance, when I was doing my space earlier, when I was talking earlier, when I was listening to other people in this space here, it came to my recollection that I didn't really make a point like I wanted to. What I was going to say was, I think that all the stuff that's going on up in Minnesota is going to bleed into the summer months, and they may use this as a reason to not allow the midterms as an election like it normally would be. And that was a point I was going to try to make earlier, but because I was passionate about what I was saying, I went off rails. But when I'm talking about technicals and when I'm talking about my life's work, I bring it down real slow, because I want to make sure what I'm saying is, number one, is close as I'm going to have it in text, and also what I've already taught in the past. But I don't want to make it hard or complicated, because while it's dense, it's a lot of things. It's not complicated. There are some rules, there's some things you have to look for, and you have to be familiar with certain things. So when I say, like, for you understand right away if I say, look at a 1-minute chart. Do you mind if I basically give an overview of one of the chapters in the book?
I love it, bro. Yes, please.
Okay. All right. One of the things I talk about is running drills. And when I did a live stream last year, I was like, look, I'm going to enter trades. Okay. And it's not meant to be right or wrong, but I want you to learn how to desensitize yourself from execution. And this is what I learned from Larry Williams, where he was afraid to get into trades. And I was afraid to get into trades too, because I was like, I don't want to be wrong. Like, I cared more about being right than being profitable. Like, I wanted to be right. So I had to work very hard, and you still hear it, and it permeates my teaching style and my character as a teacher and trader. I'm highly focused in precision, because the outcome, the money, is not important to me. It's the perfection of execution, the excellence of execution, the pristine entry, the lowest drawdown, the exits are so close to where the turning point was at. That's what I'm aiming for. I don't care about the money. I know how to make lots of money with very sloppy entry and sloppy holding. That's the easy part. But teaching and conveying the message of precision, knowing what to look for, how to trust the price run, not being scared out of the move, not being worried about what it's going to do. The way you overcome that is you simply use a 1-minute chart. Take a 1-minute chart and use what I just mentioned, well, a few times today, is you're going to have to make a little bit of investment to get the data to allow you. And I'm not familiar with anybody else's platforms, so I don't know if it just comes with real-time data. But TradingView, apparently you have to do something to get these lower time frame sub 1-minute charts. I don't care what they charge. I'm not an affiliate. They asked me to be an affiliate with them. I declined it. I kept the screenshot in case anybody ever tries to tell me, oh, you're an affiliate with TradingView. I'm not an affiliate with TradingView. I have no affiliation with anybody. But I say that for disclosure because I want you to understand that for you to really learn how to do this well and to speed up the learning curve is simply look at a 1 minute chart. Look for single highs and relative equal highs on the 1 minute chart all day long. As you see them form, mark them out. Okay. And then you're going to look at the 1 minute for your draw and liquidity, and the 5 second and the 15 second are like your 1 minute and 5 minute. That's going to be like your entry on. You're entering on the 5 and 15 second chart using inefficiencies like the fair value gap. And what you're trying to do is you're entering think of it like a silver bullet. If you think that relative equal high on the 1 minute chart is where the market's going to rip to, and it may only be 10, 12 handles. It doesn't matter. The range has absolutely nothing to do with that. You're just trying to get a feel for every price run, every 1 minute high and low, relative equal high, relative equal low. It's going to go back and forth all day long. And you're only going to do one micro contract. That's it. You're not trying to make money. You're just desensitizing yourself, getting in, trading it to the run to the high, run out the liquidity. If it continues on, let it rip. Wait for another high and low form, and then look for the other direction and back and forth. And I was basically doing that last year with a live stream. And I was saying, look, this is what you do. And some people came in, they didn't listen to the beginning of the stream. I said, this is not me trying to make money in front of you. I'm teaching you how to do drills. Okay. So you do this for a couple weeks with no bias. You're just doing it all day long. You're going to have lots of transactions. And it's very hard for someone to do this and not feel like the outcome should be way, way more in your favor. By doing it this way, you're not teaching yourself to look for the trade to be perfect. You're not looking for the trade to be profitable. You're not even looking for it to be right. You're just following the procedure of there's a fair value gap and there's liquidity. I'm aiming for that. Over and over and over again. You desensitize yourself to the outcome. Then what you want to do is after 2 weeks of doing that, you want to apply what you think the daily charts, what direction it's moving in. And then what you'll do is, let's just say, for instance, that you think the daily chart's drawing down to an inefficiency that's below current market price. So that means what? Your bias on the daily chart is bearish. So you think it's going to reach down into that inefficiency. You still are going to be buying and selling with the same drill. Liquidity above and below 1 minute highs and lows, or relative equal highs and lows on the 1 minute chart. You're entering with the 5 and or 15 second inefficiencies. So treat it like a fair value gap, silver bullet type thing. When it starts moving in the direction of the liquidity that you see on the 1 minute chart, and if it's going lower with the daily bias, you'll do 3 micros. Anything that's contrary to the daily bias, you only do 1. Now, what are you teaching yourself? You're teaching yourself to add to positions on side and in bias. But for completeness sake and to keep yourself tapped into the marketplace and teaching yourself continuously that you don't have to be right about everything, you'll see the cause and effect, the actual cumulative experience that you'll get from when the moves are likely to go lower because of the daily charts controlling that. It's the lower time frames are parent and contingent. That relationship, they're contingent upon and subordinate to what the higher time frame charts are doing. But it doesn't change the fact that you won't see little micro rallies that go higher. So do you want to put most of your position or equal to the same position size you would do when you're trading on side with the higher time frame? Absolutely not. So by having 1 in there when you're trading against the daily bias, you're getting a feel for what it's like to be engaging with that, but you're not putting a number in terms of the outcome that's going to have any real detrimental impact on you. So you're getting, this is what it looks like when I trade against what I should know not to do. But I'm also getting the experience to see what it's like in the measurement of the resistance of that move coming to fruition and how it doesn't do it very easily. But sticking to bias by having 3 micros on the same side of looking at the daily bias, drawing lower, and you have a 1 minute relative equal low or a single low is you're aiming for sell side. Again, anchored to that 1 minute time basis, entering off of a 5 second or 15 second chart, just simply looking for a fair value gap. The market drops down, creates the inefficiency, a SIBI, and then it trades up into it. Forms on the 15 second. enter on the 5 second, in case I didn't make that clear enough. That's what you're doing the whole time, all day long. You're going to have dozens and dozens of executions. And what you do is you'll see by not having a bias for 2 weeks, you have experience entering. You don't care about the outcome. You're just following the rules. There's a fair value gap. There's liquidity. I'm aiming for that. If it misses, who cares? It ain't going to do anything to you. It's not going to kill you. If you're doing with the NASDAQ, you're trading with $2 a point and it's a demo. It's not even going to hurt you. But what you're doing is you're forcing yourself to execute. What rules? This is what I'm looking for. This is all I'm looking for. It's liquidity. It's going to run there or it's not. If it's going to stop me out, it's not going to stop me out with a big stop loss. And I'm getting experience executing. I'm looking for this. I'm looking for this. And when it's forming, I'm taking it with no bias at all. On week 3 and 4, you're applying the daily bias on the daily chart. What do you think it's drawing to? Which, obviously you know what that means. It's either going to go to a higher low on the daily chart or it's going to go to an inefficiency. Where is it reaching for on the daily chart? When you apply that for week 3 and 4, doing this same drill and only doing 1 micro against that bias, but using 3 with it, then now you're going to get a measurable baseline of this is what it looks like trading against the bias with the least amount of leverage. How many times was that right? What's it going to teach you? Stick to bias trading. If you're brand new, don't try to trade against it because you'll have cold facts, data that you can support. This is right here tells me, yeah, there's a few times it probably worked out well, but chances are you're not going to find that one. You're taking every single one of them that forms with this drill. You're doing a laboratory experiment where you're spending all of your existing time that's available for you to be in front of the charts doing these things. It will completely change the whole outlook of what you're doing. You won't anymore have the outcome of it has to be in my favor. I have to be right. You'll discover that it's fun. It becomes entertaining. It's relaxing because you've done it so many times before. You know what you're looking for, but here's the caveat. Because of you watching that 5 and 15 second chart and what I was saying to you earlier, by when you're looking for price to run in a specific direction, when that 5 and 15 second chart starts leaving gaps that don't want to fill and they are behind where you were expecting price to move from to your 1 minute draw on liquidity, that information, that insight that you're drawing from these over and over copious examples of constantly putting yourself in there, doing it, you have no idea the advantage of having that. Once it's instilled in, it's like riding a bicycle. I personally haven't rode a bicycle. Let me see. 2018. I know how to ride.
Decade?
Yeah. I mean, I know how to ride a bicycle. So yeah, it's been like 8 years for me. So 8 years it's been since I've been on a bicycle, but I'm confident if I got on a bicycle, I know how to ride it. Well, once you pick up this skill, it's like it only takes a day or two for me to get back in sync with the marketplace because I know this is the skill set I tap into. But once you feel this, once you know what it looks like, it's like you have this rhythm that you plug right into. All it takes is a day or so for me to get, like if I spend the whole holiday season away from the marketplace, when I come back, I always used to tell my students, okay, look, give me a day or two. I'm a little rusty right now. I just got to get the feel and the rhythm what the market's doing. That's not me saying I got to see, if this stuff still works. I personally have to plug into what it's doing right now. And I watch the lower time frames. I do lots of demo trading. I push in all these different types of strategies on the lower time frames. And then immediately I get a feel for, okay, this is what it wants to do. And then I'm dialed in, and then everything I call for was behind a paywall, and they'll tell you I was in the high 90%. Every time I come out forward and publicly tell you in live streams, I'll go on other people's live streams and say, watch this level, note that. And then I'll come back and I'll show you an example where I actually use that level. It's applying same strategies that I've already talked about, but what I've said today is like a wonderful help. It helps build it. First of all, let me tell you the benefits of it. It will answer a lot of the things that people are fearful of. They don't know which fair value gap to use. You'll learn what that is. You'll know by examples of having done so many of them. You'll know which draw on liquidity is a good one right now. You'll know market structure better on a micro scale, which is high frequency trading. You'll be able to trade any market, not just NQ, not just Forex, but you'll be able to go into anything and trade it. Anything. I don't personally, and I would never trade Bitcoin, but I have done these things in demo, and I've done pretty good in the lower time frames, just to entertain my kids and say, look, like came around and say, can you do it with Bitcoin? I say, my students all the time ask me to do this, and I don't want to make a big deal of this, but let's just go ahead and do it. And it's the same kind of stuff, but I would never want to go do that with Bitcoin. And some of the Bitcoin runs were pretty exaggerated, which was fun when I was right, but it wasn't enough for me to come out and say, I'm going to trade now crypto because my stuff works. I've never put money into a crypto trade, and I never would. But I have students that have made lots of money doing it. So I take solace in knowing that they were able to use it there. So that to me is enough to warrant, a response. Say, look, don't take my word for it. My students, they say it works there. But it'll teach you not to fear the outcome. It'll teach you how to trust the price run that you're inside of. And also, here's the benefit. Here's the rub that nobody can really pick up on until you go through this process. You will feel it. You will feel the disconnection by watching live price action when there's a disconnect. When manipulation enters the marketplace and that trade has no chance of coming to fruition. When that happens, you'll see it and you'll feel it. The way it comes in is it'll reflect in the 5 and the 15-second chart. It's like before an earthquake happens, all these little animals and critters, they start acting crazy. What are they responding to? The little tiny micro shocks. That's the same thing that we're picking up on the 5 and 15-second chart. But then 10 minutes later, all of a sudden, shit's breaking loose and everything's shaking around and this ground splits open and you see these big cracks on the 1 and 5 and hour chart. Like it's everybody sees it now. We had an earthquake. Well, it starts on the lower time frame. So by having your sensitivity anchored to those time frames and your existing price run that you expect to see happen, when those things that you look for, the sensitivity when it's going to go higher, if it's not respecting the upper half of the PD arrays and it's exploring and laying bodies down in the lower half of them, and you break 3 PD arrays on that 5 and or 15-second chart, that's not a lot in terms of price run. And you can foresee when you should bail on the trade. And you'll have no problems just bailing. It won't be like, oh, do I hold it? What happens if I get out and it starts running? You won't feel that at all. It'll be, I'm used to this. This is not doing it. I got a disturbance in the force. I'm unplugging. And it's done. You don't have any qualms about it. You don't have any regrets over it. You just unplug. Boom, you're done. Next one. Move right to the next one. And you become a machine. You're not a worrisome organic creature that's wrapped up in a bundle of nerves. Oh, is this going to work out in my favor? Because you've rushed. You watched a couple videos. You think you understand because you saw a video. You draw out your little notes and stuff and say, okay, here's the fair value gap. And it's supposed to happen between 10 o'clock and 11 o'clock in the morning. And it's going to do this. It's going to do that. But then now you're looking at the chart. Now you have your funded account. Now you're trying to get that combine passed. Now you're trying to get your eval, to a position where you can roll into where you can start making money. And now every fair value gap looks like a middle finger saying, come on, bitch, try it. Come on, bitch, try it. That's what it feels like. It feels like you're being taught because you haven't spent enough time doing what I just said today. By desensitizing yourself, you will know which ones are effective and correct to trade on because you've seen so many of them before and you know what it looks like when price is running off of the PD arrays, where it supports it. You can see when it's going to start running and how it will stay running in your favor. I don't have any doubts at all when I'm in a price run. And that's why I'm adding to positions. I also know where the price will run back into deep retracements. Like, for instance, look at the example I did the other day. It's a silent video. That upper inversion fair value gap, until we break down to the lower lower quarter of where I thought the price was going to go, it can always retrace back up into that. Even though it was making lower lows and it broke lower and it came right back up here and stabbed up into right underneath it, that's all permissible. And you learn that comfort of not having to worry about, I got to jam my stop loss down there and protect my position. No, you don't. Who said you had to do that? Your fear said that. Your little experience, your little time doing tape reading, your little time working in demo, your little time doing drills, because you want to rush. And I understand that. It makes perfect sense for you to feel that way. I wanted to do the same thing. Just get me to the part where I'm making money, because that's the experience I'm looking for. That's the only experience that matters. Results are the only thing that matter. That's bullshit. Process is the only thing that matters. Because if you have the right process and you follow that over and over and over again and you stick to it, That process will yield a positive outcome. If what you're doing makes sense and it's a sound model and you understand price action, and you understand liquidity and inefficiencies and the ebb and flow that markets often all day long create dozens of opportunities. I'm literally telling you how to trade every hour candle. That's what that chapter is, trading every hour's candle and how to do it effectively. So that means you can walk out there anytime today. Oh, I overslept. My wife had me doing the honey-do list and I could not get in front of the 9:30 opening. I missed the silver bullet at 10 o'clock. So what do? Okay. What's the range still for 10 o'clock until 11 o'clock? What's unfulfilled? What's unfinished business? Where's the draw on liquidity? If it's still there, then trade it. If not, trade the 11 o'clock into the noon. You won't fear missing anything. It feels like, allow me to use this analogy. The Incredible Hulk. He's strong, he's powerful, he's beating up everybody, throws Loki around, ragdolls and whatever. When Thanos got rocked by him, punched him in his face, beat him all up, did Thanos have like, oh shit, this green son of a bitch he's gonna tear me up? No, he just started whooping his ass because he knew what he could do. He let him feel it. Come on, feel it. Hit me what you got. And then he walked all over the Incredible Hulk, beat his ass. Okay, well, that's what this does for you. It gives you this confidence that from the other side of the fence, people listening to you talk about what you know you can do, what you're comfortable doing. It sounds like arrogance. It sounds narcissistic. It sounds egotistical. It sounds like you're full of yourself. No, absolutely not. It's you having done all the hard work. You pushed everything aside, all the doubts, all the misconceptions, all the bullshit you hear on the internet. Nobody can time the market. And you put yourself in front of the charts and you submitted to this process. And what you'll discover inside of 1 month, 4 weeks is all it takes, folks. 4 weeks. You will be able to find setups every 60 minutes. Every 60 minutes. Now, am I saying you're going to get a 100 pip run or a 100 handle run every hour? Absolutely not. But you can if it forms it in terms of the opportunity of range expansion, if that's what you're looking for. But I'm talking about bread and butter, pay your fucking bills, get your grocery money. Every hour, you can find a setup like that. Now, what happens when you say, this is wonderful, but I only have 1 hour a day to trade. My life doesn't afford me any more time than that. Then you do this in that 1 hour trading. And you don't worry about anything else I've taught. You don't worry about what my other students are making money with. I don't care if it's millions of dollars. They get the highest payout. I don't give a shit. That's not you. That's not an invitation for you to do what they're doing. You still have to find your niche, your place in this. And it's got to be unique. But that ain't all you'll ever be. Right now, this is what you have. You only have an hour or whatever it is the time. Or if it's whatever day of the week you're limited to. Who gives a shit? That's what you have. That's what you work with. You have to adapt, but you have no excuses. Zero. None of you have excuses why you can't go out there and find something to replace your income. At the very minimum, half of your income. And that right down in the grand scheme of things, how everything's so expensive, it is so liberating to know that this skill set is available to you. And all it takes is you to sit down and say, I'm not going to come into this with any expectation. I'm going to see what comes from it. This is what the rules were. This is what I'm going to submit to, and I'm going to keep a log of what it is. How many handles or how many pips, regardless of whether you're trading, Forex or index futures or commodities, it doesn't matter. You keep a running log of this is what I did. I went long. I did one contract of a micro contract, and it was a fair value gap here, there. And it's better for you to see this at the end of the week and reflect on it and take screenshots. Really treat it like a lab experiment, like you're in college. Okay. And I don't want you emailing me this shit because so many people email me and say, what do you think about this? Like I'm grading them. Like I don't have time. If I did that to everybody, I would never get anything done. So it's not, I'm not trying to be ignorant or dismiss everyone, but it's for you to keep this information. And then once you do 1 month of it, you're going to find that you can watch price action with a lot more understanding. You'll be able to read it better. You'll know much more confidently what you think is going to happen. It won't be perfect, but you're going to have a whole lot more understanding. And then you try it on month 2 and you compare your results with what you did in month 1. And I promise you, it will be light years in advancement. And anytime you want to practice, this is what I do. When I tell you, I used to tell my students all the time when I was behind the paywall, I'd say, look, I'm running drills. I'm running drills. What is that? I'm doing high frequency trading. I'm constantly feeding myself. Is the market delivering like this? What happens if it doesn't do it? What happens if you keep getting into these trades and it keeps overlapping the gap that you're trying to trade off of? It's going to fail, isn't it? The common misnomer is this stuff doesn't work. See, look at this. The takeaway is it's teaching you that this is what this environment looks like. Don't trade in it. Don't trade in this. Don't keep pushing into this and think that you're going to get the right one eventually. Stop trading. Wait until the afternoon or trade the lunch macro. Find a 10 o'clock lower high and run into that as a retracement. You see how all of these protocols affords me the ability to, I don't give a fuck. I don't care what the market's going to do. I don't care. I don't care. I can literally wake up, don't look at the chart, don't give me a bias, walk out there, and this is what I'm going to trade right now. This is it. And I will whip the shit out of anything else out there just with that mindset and that approach. I don't need all these gimmicks. You don't need market depth. You don't need level 2 data. You don't need market profile. You don't need order flow. You don't need all that horse shit. You don't need none of that stuff. But you need to know where the market's likely to go to next. You have to have that first. Then, is the market showing you a willingness that it wants to operate in low resistance liquidity runs? That means it's not fuzzy. It's not sharing a lot of the space in the previous candles. It's elongating. It's leaving small little inefficiencies unfilled. And if there is a fair value gap, it doesn't fully close them in. You have everything in your favor now. You have everything. If you're trading in a session time that's conducive for these price runs to be there, 7 o'clock to 9 o'clock, 30 minutes from 9 o'clock to 9:30. Just relax and chill out. Grab some breakfast if you want to. And then at 9:30, wait for that opening bell. First present the fair value gap. If there's a gap, where do we open? Where's the mid gap? Right there. That's the first thing you're going to do. You see how there's rules to this? And it's just one thing after the next. This is what we're looking for. The whole day, I have a whole protocol based on what time of day it is, what I'm looking for. This is what's going to be in the book, but I've already taught it all. I've already taught all these things. And to have, I guess maybe in a way it'll be helpful for you to have it in a book form because it's like, here it is in text format. This is all in this chapter. This is what I concern myself with in this order. This is when I do this, that, and the other thing. I guess,
It's very similar to what you've done, Michael, with the price action models for the charter students. If you go back and you look at how you did the core content versus how you did a few different other series versus how you structured the modeling specifically for your price action model series, it's kind of similar, I would think, just kind of incongruent how we're kind of talking about it, I don't know if that makes sense.
Maybe. I purposely made some very advanced models though because I knew I was getting leaked. But those models are awesome.
They are awesome, and my point was because I'm a construction guy, and when I think of construction, I think of like a guidebook, I think of a handbook, I think of a specifications, I think of certifications.
SOPs.
Yeah, SOPs, exactly. Yeah. So, and I mean, again, construction for me, I dealt with from engineering materials, I dealt with a lot of specifications. So what are the specifications, the criterion towards, again, your modeling, how you see things, the context that you do it. Again, like how you package it. And the way you package the price action models was a way in which you packaged it, right? The way you package what we're talking about right now as well. It's all, I don't know, it's context, perspective, kind of. And as you're mentioning, like in a book, it's, I don't know, it's almost like a contextualization. I don't know.
Yeah. SOP, I guess, is the closest.
Yeah, SOP is, I think, the right way of putting it.
Yeah. I'm not sure if the audience has gained anything by what I've been discussing with you in the last half an hour or not. I don't know. I'm confident that you pick up on what I'm saying. It makes sense to you because you spend a lot of time in price.
Absolutely. And well, hopefully, here's the thing. This is recorded. And also there are folks, I think it's good within the community that, I mean, a lot of folks understand that there's kind of levels to the game, right? And there's
Yeah.
different levels of conversation, and you feel comfortable with me. And even though I can be maybe verbose and, as you've said, kind of extroverted with how verbose I can be in unpacking your concepts maybe in one breath. And you're like, wow, how do you do that? Like, wait,
Yeah.
did he breathe? What the
Yeah.
fuck? Uh, but,
Yeah.
it's, but anyway, it's that kind of thing. Like there's a level of learning to all of these things, and being able to convey something or articulate it, consistently. And I know that's very important to you, is being able to convey things consistently. And then I think one good thing is, from a community standpoint, we can convey a lot of things consistently in the same regard. And I mean, one way I think I've tried to get on board with that is like the macros and the 50/10s. Like, I really love how you came in and was like, no, hold on. Let's just set the story straight right now. This is what it is. This is like, I know there's, just like you did with the SMT, just like you've done with, market maker models, like you come in within the community and you're able to see from the comment section, you're able to see from what other folks have said in other places, and you're able to be like, nope, wait, hold on. Let's clarify how things really are. And
Yeah.
like,
Just a
SOP.
recalibration.
Yeah.
Yeah. I mean, I don't discourage anyone's observations and discoveries. But if you don't keep in sync with what it is I'm teaching and how I taught it, the things that will come later on in your understanding that's already been taught, they won't dovetail nicely. They'll feel disjointed. And by having, now, as you mentioned, a macro time, if you apply that also with your drills and you start looking for those runs on liquidity during a macro time, you're going to discover that, wow, there's so many easy setups that form just like this every single hour. You have a 20-minute little sweet span of time where if your mortgage payment's $4,000 or $5,000 a month, it don't take many of these to get that covered, and you don't need to be doing it with 15 contracts on the mini. You can stay in the micros and just comfortably build it up a couple times a week, and then boom, your mortgage is covered. How many lives would be impacted for the better if your mortgage entirely was covered by your trading? And that's all you ever could accomplish, because you couldn't do anything better than that. You couldn't build it in beyond that. You don't feel comfortable taking more risk or trading larger than that, because a lot of you are going to discover when you are making money, you can be really good at trading. But when you start getting into higher levels of equity, you have to grow into that. Like when you put size on, it's scary. It causes a new level of fear. New levels, new devils. Okay. When you get to this level of larger equity behind you, and you're not just doing 1 and 3 and 4 and 5 micros, now you're in a range where you're doing 25, 50 contracts of mini. If you're going to stay on a graduated dollar risk basis. So in other words, you're only going to do 1% risk of total equity. Well, as you grow, if your equity's growing up, that's going to equate to, well, what's 1% of 500 grand? You're going to be in the minis. Like, you're not going to just stay in the micros. You're going to be in the minis. So that will afford you larger position sizes if you're going to do that. Or do you say, I tried doing that. I freak out. I feel the pressure of it, moving that kind of money around, even though it's 1% of my account. It just messes with my head. I'm just going to be an income-based trader. So that might be some of you, that's all you ever do. Is that failure? No way. No way. And I'm anxious because I don't want to teach a way where it sounds like this is the only way, using what I just talked about today. It allows you to bring your own personality, your own walk in life, your own circumstances, what you have, your own financial circumstance, your marriage, your relationship, your dependencies, all these things, your business, your work, your university schedule, everything. This allows you to plug and play that. And there's no excuse. You can say all you want that you can't do this, you can't do that. But if you got 1 hour a day, you can trade.
Yep.
That's it.
And
1 hour
like
trading.
I love that. And I mean, I'm trying to follow that assignment. And I mean, we have a TBR macros indicator that goes over hourly macros. And I mean, I'm trying to show that within how I live stream as well, following that assignment. And I believe that's really great within 2026, or at least that's really good, a way I feel like in following the assignment. And I love that is, I mean, the hourly macros are really it, right? Like, I mean, that's your daily bread. If you can get in sync with a lower time frame within any given hour, and I mean, I personally think of the macros, Michael, and I know other folks look at different things, but, I'm thinking about just that within the hourly macros and an opportunity for, as you're saying, just as you've said in the past, daily bread,
Yep. Well, listen, Guy, I have had fun today. I've had an opportunity to spend time with you, break bread with everyone, hang out, listen to everybody's opinions and whatnot. I learned a couple things from a couple of the students and what they were supplying in terms of how they would look at certain things. I didn't get as many things as I was hoping to hear from other people, but the things I did get, I'm thankful for it. I'm thankful that I had an opportunity to hang out with you today and talk to you and have the audience listening to. Hopefully they got something from it. Hopefully, they gleaned some kind of a, helpful insight that they can now work with going forward in the next week and put it to test. Just get the data, pick it up, see what it looks like in your hands after 2 weeks, and then watch 3 and 4th week doing the same thing, using a daily bias. And if you want, I will tell you daily bias each day, but I won't tell it to you until 2 have passed. So that way everybody has to do it the right way with no help from me. And then I'll tell you daily bias, each day, week 3 and 4. But after that, it's all on you guys. But that way you can work with that mindset, 1 against it, 3 in sync with it, but 1 only micro contract for week 1 and 2, and get the data for that. And I think that you will be pleasantly surprised on the experience that it gives you. But I'm going to escape. I have something to take care of my wife and spend the rest of the weekend with her because she's giving me the hairy eye.
Hey, well, 4:44. I love the time. I'll
There
just
you
say
go, brother.
that.
Have a good weekend, man. Take
All
care.
right. Much love, Michael.
Take care.
Take care.